Hi everyone. Thanks to everybody who's after joining us so far. My name is David Looney. I work as a financial advisor with Alpha Wealth, and today's webinar is redundancy packages and severance options as severance payments, knowing your options. It's something that's very topical at the moment with a lot of major Irish employers announcing a lot of layoffs, particularly in the last 12 to 18 months, and particularly in the tech sector. It is something we've been quite busy with over the last couple of months, engaging with clients who might be facing redundancy or are looking at redundancy currently. And what I find, I suppose, is that, some of them are happy about it because it gives them a bit of a financial cushion to take some time off work, decide on what they want to do next, maybe spend some time with family or go traveling. And naturally, some people are very, very concerned about it. And I think irrespective of what side of the coin you find yourself on, the overarching message here is that it's really important to get financial advice and specific advice to your particular situation, because there's a lot of decisions that you have to make, and it can have a big implication not only on your current financial situation, but obviously an implication as well in terms of your future financial situation. So with that in mind, what you will all get from today's webinar is, firstly, what are you entitled to if it comes to redundancy or severance, and how is that calculated? What the tax options are around your lump sum payments and how that impacts your payout and your retirement benefits, how you can possibly look to reduce or offset some of the tax on your redundancy payments after you get it or before you get it, and just some general financial planning and retirement planning advice in the context of all of that. I am conscious that we have had loads of people register for today's webinar who might have not been on these webinars before, or might not be too familiar with Alpha Wealth. We actually had about 300 people sign up to today's webinar, which might just be an indication of, I suppose, how topical the area is at the moment. But just to give people a quick introduction to Alpha Wealth, if you're not familiar with us, as I said, I work as a financial planner myself. I've been in the industry for about 10 years now. And in Alpha Wealth, we run an impartial financial planning and advisory company. So we basically work with individuals and families like yourself, and give you independent advice in, many different areas in that personal financial planning space. We've 10 staff members in Alpha Wealth currently who are either QFA or CFP qualified. And as I mentioned, we provide specialist advice and solutions in things like financial planning, savings and investments, retirement planning and pensions, protection tax, mortgages. I'm happy to say at this point we're coming up to our 10th year anniversary, which we'll be celebrating this April. And over that period, we've amassed 4,000 clients from all around Ireland who now have over 250 million of assets under management with us. So we are quite experienced helping people to manage their money more effectively. Just to mention, I am joined by some of my colleagues today, including my colleague Nick Charalambis, Clean O'Donoghue, our business development manager, and Ruth Murray, our marketing manager. And if anybody has questions throughout the webinar, feel free to pop them into the Q&A box or the chat box. Look, and we'll do our best to get to them either throughout the webinar, or else we'll allow a bit of time at the end. And just to mention as well that anybody who's on the webinar today is more than welcome to get in touch with us if they need one-to-one advice on their specific situation after the webinar. So redundancy packages, what does it look like? Essentially, a redundancy package is made up of two parts. Firstly, you have something called statutory redundancy, which is what you're entitled to by law, and that's 2 weeks gross pay for each year of service you have with your employer, plus 1 additional week's gross pay. All of that is tax-free. And it's important to note that that weekly payment is actually capped at €600 per week. So if you are earning in excess of that, you can only use a maximum of €600 per week in your calculations. So that's what you're entitled to by law, and it's tax-free. The second part then is what's known as ex gratia redundancy, and really that's up to the discretion of the employer. It's usually an incentive-based payout. Part of that can be tax-free as well, and part of it can be taxable at your marginal rate, which is usually either 20% or 40%, depending on what rate of income tax you pay. And there are 3 ways basically to determine how much of the ex gratia payment is taxable and how much of it is tax-free, which we'll be getting to in a second. Just so this kind of resonates with people, I think it's always helpful to look at an example. Here we have Joe Bloggs, age 30, and the 5 key pieces of information that you'll need to know and will need to know always when it comes to calculating your redundancy and also how much of it is taxable is your current earnings, your earnings over the past 3 years, your service with the company, what the current value of your pension is, and what the present day value of your pension tax-free lump sum is. Now, I appreciate that most people on the call might not know those last two ones, but if you are in an active pension scheme, that information can be obtained quite easily, and the pension scheme provider or the actuaries can calculate the pension tax-free lump sum for you, and it's usually given to you in the redundancy process. But just looking at this chap here, and as an example, his statutory redundancy would be €600. That's the capped weekly payment by 2, multiplied by his 9 years of service, plus an additional 1 week's gross pay. So he'd be looking at about 11,500 tax-free. And then in addition to that, you have an ex gratia payment, which is up to the discretion of the employer. A typical one that I've come across is weekly earnings by 6 by years of service. So again, in this chap's case, he's looking at 1,192, which is weekly earnings on a total annual income of 62,000 by 6 by his 9 years of service, taking him to 64,368. And as I said, part of that ex gratia payment can be exempt from tax, and part is taxable. It's based on 3 calculations, basically, with the highest answer equaling the amount that is tax-free.
So, David, I'm going to jump in there because there's some questions popping in already, and I'll just
sure.
2 of them to you. So if you take a redundancy payment, can that affect the lump sum you take from a pension?
Yes, good question, and I should have, I suppose, spent a bit more time on that. The reason that I'm talking about pension values and pension lump sums is that if you have an active pension, when you retire, whatever the future value of that pension is at, let's say, 60 or 65, or whenever you decide to retire, you'll be able to access part of that overall pot, usually as a tax-free lump sum. It's usually about 25% of the fund. So let's say an individual has 400 grand in a pension at age 60, they can take 100,000 as a tax-free lump sum. Now, why it's important in the context of redundancies is that with these 3 calculations that we're going to look at in a second, you basically have an option as to whether you are in favor of waiving your right to that future tax-free lump sum from your pension in return for getting more of your redundancy payment tax-free now, or whether you would prefer to take less of your redundancy tax-free now and retain the right to the tax-free lump sum from your pension on retirement. So you'll understand a bit more as I go through these. So the first way to calculate, or the first exemption, is something called a basic exemption, and that's €10,160 in addition to €765 for each year of service. Don't get too bogged down by the details. Look, and as I said, I will share this recording and these slides with people after on request if they need it. With this particular calculation, there's no requirement to give up your tax-free cash lump sum. So depending on some people's situations, they might find that the basic exemption is actually giving them the highest calculation. Then you have something called the increased exemption, which is basically the basic exemption above plus an additional €10,000. However, you then take away the tax-free lump sum, the current tax-free lump sum value from your pension account, which we showed an example of there earlier, the present day value of the tax-free lump sum. Now, with that particular exemption, the increased exemption, it's only accessible if you haven't received a tax-free lump sum amount in the last 10 years, or if you aren't currently receiving or will soon be receiving a lump sum from your employer's pension. So you can forfeit your access to a tax-free lump sum, as I said, from your pension payment on retirement if you are choosing the increased exemption. The third exemption is something called standard capital superannuation benefit. It's a bit of a mouthful, but people, the abbreviation is SCSB. And for most people, particularly those who are higher earners, this will usually give the highest answer. And how you calculate it is the average annual earnings for the last 36 months, so the last 3 years of service, divided by your years of service, multiplied by your years of service and divided by 15. And then again, you have an option as to whether you subtract your current tax-free pension lump sum from that amount if you want to retain it, and therefore it reduces the exemption figure, or else you don't subtract the current tax-free pension lump sum, and therefore it increases the exemption. With these 3 calculations, it is strongly advised to get it verified by a third party. And as I said, if we just look back at this chap here and what those 3 exemptions might look like for him. His basic exemption basically is the €10,160 plus the €765 by his 9 years of service, which would be €17,045. His increased exemption would be the above figure here plus an additional 10,000, which would take him up to 27 grand tax free. But then with this increased exemption, as I mentioned, you do waive your right to the tax free lump sum from your pension, or under the SCSB calculation, the annual earnings for the last 3 years, which you can see up here, the average of the last 3 years' earnings, multiplied by his 9 years of service and divided by 15, gives a figure of 32,000, but also waiving the right to a pension lump sum. Or if he decided to take away the pension lump sum to retain the right, you're looking at 17,000. So basically, in this example, the highest exemption is the SCSB at €32,000 here, but that involves waiving your right to a pension lump sum. Or if you decide not to waive your right to a pension lump sum, the highest is the basic exemption. So basically, the net payout for this individual, if they're waiving their right to the pension lump sum, is 59,500, or if they're not waiving their right to a pension lump sum, 52,000. So basically, there's a difference of about 7,500, and most people basically will have that option as to whether they want to waive the right to the pension lump sum on retirement to get more tax-free now, or else retain the right to the pension lump sum at retirement in order for getting slightly less tax-free now. So the big question,
David, can I just ask you on that? Are there any hard and fast rules, or is that why it's really important for everybody to kind of, get a consultation and look at their own individual situation? Or is there, would you recommend waiving the right or not, or is it important to get advice?
Yeah, it's a great question, because it really is dependent on your individual situation. And if you go back to the factors that determine not only the redundancy package, but how much of it is tax-free, the individual details can really skew the figures. So some people, you'll find that they're not really losing out on much, irrespective of what option they choose, and some people it might have a bigger implication for them. So again, if we take it back to this example here, this guy Joe, if he gives up the right to his tax-free lump sum, he's going to get an extra 7.5 grand now. So it really depends on his individual circumstances and maybe his need for cash, which is why it's so important. Now, why it's so important, why the lump sum from your pension on retirement is handy, is that not only is it completely tax-free if it's under certain thresholds, which is a maximum of 200,000, but it also allows you to kind of set yourself up for retirement. So we mentioned that Joe has a pension of €60,000, and let's just assume that it growed at a 6% per year average interest rate for the next 30 years until he's age 60, which is a very doable interest rate, by the way. He'd be looking at a fund value of about 345,000. As I mentioned earlier, he can take 25% of that as a tax-free lump sum, which would be about €86,000 at age 60. And that really is going to give him a lot of options at age 60. What we're finding, a lot of people now are maybe using that to clear their mortgages, because people are borrowing a lot more over longer terms, and therefore they can use the tax-free lump sum from their pensions to retire early and wipe out their mortgage. He could also maybe use it to buy another property or a rental property, or even use it to travel. So some people might be shooting themselves in the foot. So for the sake of an extra 7,500 now, they might be losing out on a lot of options down the line, which is why it's important to get tailored advice to your specific situation. Because the best option for one person, as I said, won't be the best option for another person, and the individual details in terms of your salaries, what your current pension value is, etc., can really skew the figures between different people. So if you are looking at a redundancy package which is partly taxable, there are 2 main things that you can do to maybe reduce the tax further outside of the 2 exemptions that the 3 exemptions that we just looked at. The first is making a last minute AVC. Now, for those of you who don't know what an AVC is, it stands for additional voluntary contribution, and all it really is just an extra payment into your pension, so like a lump sum pension contribution. So if you're still working for your company, you can actually make a last minute pension payment in some cases. The amount that you can pay into your pension is relevant to your salary and your age. So let's say, for instance, you're on a salary of €80,000, and you paid €5,000 into your pension through regular payments. If you're in your 40s, you can contribute basically 25% of your salary. So you can squeeze 20 grand into a pension for each year. Now, you also have an ability to backdate a contribution to the previous tax year. So for instance, like I could make a pension contribution now towards last year and claim the relief immediately. So in this case, this individual could actually squeeze an additional €15,000 into their pension for last year. And if they put that 15,000 into the pension and offset it against 2023's income in a tax return, and they're a top rate taxpayer, which they are, revenue would actually return them €6,000, which would cost them only €9,000 to put the €15,000 into their pension, and therefore shave €6,000 off their overall tax liability and reduces the tax impact of the tax on the redundancy. It must be done before your last day of service, so it's important to maybe link in with your employer to see if it is viable, a viable option for you. Some people are a bit reluctant to do that because they see it as, tying the money away for a very, very long period of time, but it is really attractive in terms of the return that it gives you and the tax saving. And remember, most pensions can actually be accessed from 50 onwards. I still come across a lot of people that think that they can't access their pension until 60 or 65. Most pensions, particularly company pensions, can be accessed from 50 onwards. The other thing that you can avail of to reduce the impact of the tax is a tax-back investment scheme known as the Employment Investment Incentive Scheme, or EIIS for short. And basically what it is a revenue-backed revenue-backed investment scheme whereby individuals can invest in qualifying Irish companies, typically over a 4 to 5 year period, in return for a tax break of up to 50%, depending on the company that they invest with. The minimum investment is usually about €5,000 per company. So really what you'd be looking to do here is take your redundancy, suffer the tax on it, and maybe consider putting some of the after-tax redundancy payment into a qualifying EIS scheme to claim some or all of the tax that you suffered back on that portion of money. The tax relief level really depends on the type of company that you invest with, and this is a scheme that Alpha Wealth have been dealing with ourselves for many years, so we're always looking around at some of the types of companies that are looking to raise EIS capital. We always try to cherry pick the strongest companies because it does involve risk naturally. These are just some of the companies that we work with in the last couple of years, and if anybody on the webinar today would like to get a bit more information on this scheme or the potential opportunities for EIS this year, feel free to reach out to us afterwards. But as I said, the benefit from a tax perspective is the revenue rebate, which is given in year one, and then also an additional return from the company that you invest with at the end of the term. What I just want to move on to now is pension options after you leave service. And some people might be wondering why I'm talking about their company pension, because today's, I suppose, webinar is specific on redundancy. But what a lot of people don't realize is that if you leave a company, you actually have a massive opportunity with regards to the pension from that company. And many people can be losing out on a big opportunity cost by not taking action. A couple of weeks after leaving service, you will usually get out something in the post or by email called a pension leaving service options, and there'll usually be 4 options on it. The first is to leave the money where it is and you just access the company pension under the normal scheme rules at whatever 60 or 65. The second option is that you transfer it into your new employer's pension scheme if you go to work for a company that has a company pension scheme in place. The third option is that you can transfer it into something called a personal retirement bond or a pension bond or a PRSA, which tends to be the favourable option for most people because they just move the pension into their own name. It's not linked to the old employer, and they get to access that from age 50 onwards. So it puts, the ball into their court and gives them all the control. There is a fourth option, basically, which is to take a refund of all of your contributions, less 20% tax, but that only applies if you were a member of the company pension scheme for less than 2 years. Now, while we're on that topic, I'm not a big fan of people leaving money in their old company pension scheme, nor am I a big fan of people moving the pension into their new employer scheme. The reason for that is that if you move on from a company, it doesn't really suit you to have your pension in an old employer scheme. You know, you've moved on from the company. You don't really want to be tracking down the company when you want to retire, asking for permission to access the scheme or sign off on any documents. And you lose a lot of kind of control and transparency, and you're quite restrictive in terms of the options within that pension scheme. Similarly, if you transfer it into your new employer's pension scheme, some people see it as consolidating all of their pensions into one scheme, which can seem favourable, but again, you can shoot yourself in the foot, because it can be quite advantageous to keep your pensions separate, because you can draw them down at different points in time. For instance, what we're seeing is a lot of people now are doing this phased into retirement approach, where maybe they'll go back to 2 days a week or 3 days a week in their current employment. And if they have another pension knocking around from a previous employment that's separate to their main company pension scheme, they can draw on that to supplement the reduction in income from going back to part-time. Whereas if you move all of your pension funds into your current employer scheme, they're now all tied up to a point where you either leave or retire from your existing company. So you lose a lot of options. So in our experience, the best option is to move it into this pension bond, where you just move it into your own name. It's kept separate. You can access it from 50 years of age. And most importantly is that you can access any pension investment fund or pension provider in the Irish market, rather than being restricted to what your old scheme provides or what your new scheme provides. Because the two most important things when it comes to your pension is, one, where is my money invested and how is that performing versus what else is out there? And two, how can I access it and how easy it is to access? It's important to note that the strength of your employer is completely irrelevant in the case of a defined contribution pension. Sometimes I meet people and, they worked with Apple, let's say many years ago, and they're afraid to move their pension out of Apple because they think that, there's some kind of security there. The value of your pension is tied to the fund that you're invested in. So if that fund isn't performing, or it's not performing as well as other funds that are available, your company or the employer is completely irrelevant, and they're not going to stand over it.
David, sorry, on the subject of pensions, another question has just come in. Annuity or ARF?
Yeah, good question. Again, it's one of those ones where it's not a one size fits all. But what I will say is that in my experience, probably over 90% of people nowadays, when they're drawing down a pension, go with an ARF, an approved retirement fund. The main reason for that is that annuities, their rates have been slashed over the last kind of 10 to 20 years, because people are living a lot longer, and we're in times of lower interest rates versus years ago. So basically you're exchanging all of your fund value for a set rate. At the moment it's about 4%. So basically for each 100 grand that you have in your pension pot, an insurance company is giving you income of about 4 grand a year for the rest of your life, which is great if you live to 120, but if you kick the bucket after 5 years, you're at a huge loss and the insurance company is at a big gain. So what most people do nowadays is they put the money into an approved retirement fund, where it just kind of sits in a pension account, and you decide exactly how much you want to take out each year as salary. So you can take more some years or less other years, or you might find that some people will take more between age kind of 60 and 66, and then take less once 66 comes around, because their state pension kicks in. It allows you to maybe take 20 grand out to buy a new car, whereas in annuity it's a set income every single month or every single year, so there's no flexibility. With an approved retirement fund as well, you can continue to invest the money, and anything that you don't take out continues to grow tax-free because it's still in a pension. So arguably an ARF in today's world is much, much better value. But again, some people might, need the guaranteed income, particularly maybe if they're, older, much older, when they're drawing down their pensions, worthwhile, linking in with us. But as I said, a really important thing when you are reviewing or analysing your specific pension is, what fund are you invested in? There's many different providers in the Irish market, and they all have loads of different funds. So there's hundreds of funds essentially that you can be invested in. And nobody on this call can tell me that their company pension scheme gives them access to the best performing fund in the Irish market. Alpha Wealth operate as an independent financial broker, so we're not tied to any provider. But what you can see here is some of the main medium to high risk multi-asset funds in the Irish market from the various pension providers. Irish Life actually have a massive share of the corporate pension business in Ireland, but their fund performance has been brutal for the last couple of years. And then you've other companies like Mercer and Aviva. Zurich would be my preferred provider of pensions. I've no vested advice in saying that. My own pension is with Zurich. But if you look at the performance of Zurich's Prisma 5 over the last, let's say, 5 years, it's returned 63%. Versus an Irish Life fund, which has done just 26%, or another one called the Consensus Fund that a lot of people are in might be 40%. You've a Mercer fund doing 42%, and the multi-asset ESG Aviva fund with 33%. So if you leave a company, it gives you a great opportunity basically to move your pension fund to a much better performing fund, and it gives you essentially more options there. Now, some people might say that, oh, the difference here in the funds isn't that much. But even if you take a small annualized difference in a pension fund, let's say 2% per year, if you have a pot of 50 grand growing at 4% per year for the next 30 years, your future value will be 162,000. Whereas if you have the same fund growing at 6% per year for 30 years, the fund value is 287 grand. So you can literally be costing yourself hundreds of thousands of euro by ignoring a proper review of your pension account, or by leaving your pension in a previous pension scheme that might be with a provider who isn't really, leading the pack in terms of the returns that are offered out there. Outside of pensions, there are some other benefits that people might want to consider, or consider that they might lose on their exit. The main ones tend to be debt in service, which is kind of like life assurance. Usually you'll hear people will have a payout of say 2 times or 4 times their salary if they die in service. Then you have an income protection policy, which basically replaces your income if you're out of work due to sickness or injury. And then some people might have health insurance covered by their company as well. So it's important to ask yourself, do you need to affect any personal policies to protect you and your family now that you might have lost these employment benefits? Some people might have shares as well in the company that they worked for, and it's important to get, I suppose, advice around that as well. And we can help people there as an independent advisor. If people do come out with, large lump sums from redundancy payments, and they maybe go back into another paid job, particularly in the short term, I'm very much against people just leaving large amounts of money sitting in their bank account, because the real challenge that we all face is inflation, and no bank, credit union or post office in Ireland at the moment gives a return which is outperforming inflation. So your savings value is just dwindling over time. So one of the fantastic options out there available in the market that we would encourage people to explore for maybe a portion of their monies to get it working and to get it keeping pace with inflation, is looking at some of the accessible savings investment plans that are offered through some of the various insurance companies. One that we deal with a lot is the easy access plan that's offered by Zurich. Again, it comes down to the market leading funds that they have, but it basically allows you to invest a lump sum or monthly contributions in a savings plan, which is very flexible, and the term of the plan is completely open-ended, so you can access your money at any stage at no penalties. And what that plan does is gives you access to a wide range of savings and investment funds, which are different risk and reward levels, and that can be changed throughout the term. So there's an option there basically for every type of individual. A plan like this really is ideal for any kind of medium to long-term savings goal, such as saving for your children's education, or maybe ring fencing an amount of money for a particular cost that might come up in life. And we can arrange these types of plans for anyone on the call at some of the lowest fee structures in the market. For instance, we give all of our clients 101% allocation. What that means essentially is that for every €100 that you put into this plan, we give you an additional €1 on top of that to turn it into €101. And the reason we do that is that there's basically a 1% government levy which is taken from any investments to these funds. So we're basically reimbursing you for that government levy to make sure all of your investment is invested from day one. And I can assure you that's not standard in the marketplace. I've seen allocation rates as low as 95% from a lot of other providers and banks out there. So people are suffering a large entry cost as well as the 1% government levy. Just to give people a bit of information on exactly what a fund within the Zurich plan might look like, one of the funds we deal with quite a lot is a fund called the Balance Fund, which would be Zurich's oldest and most popular fund. It would be kind of a moderate risk fund, so very, very well diversified. what I like about it is it has a 35-year track record. So it's launched in 1989. So there's a lot of comfort that comes with that. It's managed by Zurich, who, look, I appreciate some people might be familiar with, but they are the largest insurance provider or investment manager operating in Ireland, and one of the largest worldwide. So what you're getting with that is a lot of experience, security, and a very kind of hands-off approach for yourself. But what this fund does is provide you with exposure to over 600 assets worldwide, including things like equities, which are stocks and shares, government and corporate bonds, cash and alternatives, all within the one fund. So it's giving people huge levels of diversification and risk management, at no management on, I suppose, on their behalf. And its returns are absolutely stellar. And the average annual returns over that 35-year period are in the region of about 10% per year, less roughly 1% per year fund charge. So you can see that there is a long-term track record of the fund producing quite an impressive after-charge return, and a return that significantly beats long-term inflation, to make sure that you are getting a real positive return on your money and that is working for you. If anybody is interested in linking in with us to book a full financial planning consultation, where we can really review your individual situation and make sure that we're putting a plan in place to improve your situation and improve your financial future, we do offer that service for our clients. Our once-off cost, which covers all subsequent meetings and advice, is usually €199, but we have decided to offer a reduced fee to anybody on this webinar who is either facing redundancy or might possibly be facing redundancy. As I said, it is a once-off cost that covers all subsequent meetings and advice, and we'll basically review your situation and help you build a financial future when you're in control, understand the leaks and gaps in your current financial setup, help you to establish short, medium and long-term financial goals, and provide independent projections and savings and pensions to help you get there. Increase your savings and disposable income by switching to cheaper policies and rates on your main financial outgoings, along with budgeting advice, and provide tailored investment solutions to get your money working harder. Ensure you're operating as tax efficiently as possible to put more money back into your pocket, and also helping people get to this point of financial independence or even early retirement to achieve and maintain your desired lifestyle into those later years. And if anybody, as I said, wants to get in contact, my own contact details are there on screen. Feel free to drop me an email, and we can advise you on the best course of action going forward. And look, we'll just want to take this time to thank everybody for their time. I hope you got some benefit from it, and we can maybe open up a bit of a Q&A session now if there is any questions in the chat box or the Q&A box.